and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day. India appears set to overtake Germany and Japan to become the world's third largest economy by the end of this decade. It is the world's fastest growing major economy right now. But this rapid growth is not without a cost. India is the world's third largest oil importer as well. Oil is fueling the growth but denting the exchequer. The government is now planning to almost double the crude oil refining capacity. But what are the challenges? Tushar Verma's report has the answers.
As the Russian tanks rolled into the neighboring Ukraine in the February of 2022, the price of crude embarked on a steady upward march. Within a few months, it touched a whopping $139 per barrel, highest in the last 14 years. And with it, the profit of domestic companies like ONGC and GAIL also shot up. In July of 2022, the Indian government imposed windfall tax on oil and gas production companies to tax the high profits being made by them due to external factors. But according to industry insiders, India's windfall tax regime is deterring foreign oil majors from investing in the oil exploration and production sector in the country. And according to a Business Standard report, at least 2 major foreign oil companies have raised this concern with the government during a recent meeting. In December last year, the Minister of Petroleum and Natural Gas, Hardeep Singh Puri, had said that India is expecting an investment of $58 billion in exploration and production of crude oil and natural gas. He also said that India will increase the geographical region under exploration from 8% to 15%, touching 0.5 million square meters by 2025. At a time when the government is making policy changes to promote the industry and is expecting large investments, how will the windfall tax impact India's oil and gas planning?
The economic rationale behind the windfall tax, that essentially there are 2 objectives the government is trying to achieve. One is to try and tide over the trade deficit. The other rationale is, in some sense, the producer do not start creating the supply side constraints in the domestic market. Now, do the crude producing companies anticipate such super profit tax? There is an anticipation because India is not the only country that levies this tax. But I guess there is also a counter-cyclical effect, right? So unless there is an overall exit plan, it could eventually come to hamper the investments, now both for domestic producer as well as the foreign producer. But till the time it lasts, and now that it has stayed in play for about 8 or 9 months, if there was to be a new investment today, then the producer will have to account for it and pretty much model it out in their financial planning.
Companies like Chevron, BP, and ExxonMobil have already expressed their interest to invest in India. The petroleum minister had earlier said that major global oil companies are in advanced stages of discussions to enter India. In such a scenario, what challenges will the windfall tax system pose for foreign players?
Whenever a global oil major would look at prospectivity, it would look at return, it would look at a lot of those factors. Now, India has had a poor, geological data. One, it has suffered from that for many years. And secondly, with this windfall tax, also there would be their realization reduced. Global majors, when they're looking at which country to put in their money, they want to invest in a very short-term or more short-term, more projects which have a higher probability of success. So given all these factors, they would rather look at countries such as Nigeria, where there are greater chances of success, one, as well as a higher realization that they would be able to get.
The windfall tax is a cherry on top for the government's treasury. only 7 months old, it is expected to add 25,000 crore rupees in taxes by the end of FY23. With global crude oil prices appearing to be on the rise again and the Russia-Ukraine war nowhere towards ending, the windfall tax might be here to stay. The Central Board of Indirect and Customs, or CBIC, recently said that windfall tax will continue for some time at least. Business Standard reported, quoting a Petroleum Ministry official, that there has been no interministerial discussions on scrapping of windfall tax. India is the world's third largest oil importer. With a growing economy, imports are only set to increase. India's share of global demand is set to go up from 5% to 11% in the coming years. Further, only 15% of requirements are met internally, while for the remaining 85%, India is dependent on imports. Hence, the government is looking to almost double the crude oil refining capacity from 250 million tons per annum to 450 million tons per annum. This will naturally require significant investments. Windfall tax will act as a deterrent for major global oil players. Without a phase-out plan, it will affect investments in the oil and gas sector. The companies are already taking it into account while planning their investments. India also has poor geological data, which further adds to the list of obstacles, especially when other countries may give better value realization to major players.
Windfall tax has also eaten into the profit of Reliance Industries. Meanwhile, India's biggest company by market valuation has recently put in place a succession plan. India's corporate empires are in the midst of transition. The Aditya Birla Group too has initiated a succession plan. Ananya Birla and Aryaman Birla, the two children of Kumaramanglam Birla, were recently inducted into the boards of group companies. So who are these two new Birlas? Bhaskar Kumar's report introduces them to us.
She is an established singer and songwriter with over 540,000 followers on Instagram. 5 of her singles have achieved platinum or double platinum status. 28-year-old Ananya Birla is also the founder of Swatantra Microfin, one of India's fastest growing microfinance institutions which empowers women in rural India. And her younger brother, 25-year-old Aryaman Birla, is an established sportsperson. He made his first-class cricket debut in the 2017-18 Ranji Trophy playing for Madhya Pradesh. He also represented Rajasthan Royals in the Indian Premier League for 2 seasons. Now, both are set to play a larger role in the $60 billion Aditya Birla Group, the business empire run by their father, 55-year-old Kumaramanglam Birla. On 6th of February, Ananya and Aryaman were inducted as directors by the board of Grasim Industries. A few days earlier, on the 30th of January, the brother-sister duo were inducted as directors on the board of Aditya Birla Fashion and Retail. They were also included on the board of Aditya Birla Management Corporation, the apex body that provides strategic direction to the group's businesses. Grasim, Aditya Birla Group's flagship company, houses the viscose staple fiber and chemicals businesses. It also holds a majority stake in the group's cement business, Ultratech Cement. And the company has forayed into the paint segment too. The conglomerate consists of 33 companies which operate in fields ranging from cement and telecom to financial services and aluminium. The group has 6 companies listed on the BSE and NSE. After their induction, Aditya Birla Group chairman Kumaramanglam Birla said that Ananya and Aryaman's appointments had come at an appropriate time, as Grasim was at a pivotal juncture and on the verge of creating what he called 2 new high-growth engines, paints and B2B e-commerce for building material. He said that Ananya and Aryaman's business acumen and insights into new age businesses and consumer behavior would be valuable for Grasim. So, what do they bring to the table? Ananya Birla founded Swatantra Microfinance at the age of 17. With over 7,000 employees, its assets under management have crossed $1 billion. And a group company release said it had grown at a compound annual rate of 120% between 2015 and 2022. The release also said that Swatantra had a CRISIL A+ rating, adding that it successfully acquired Micro Housing Finance Corporation in 2018. Ananya is also the founder of a home decor brand, Ikai Asai. She is also the founder of the Ananya Birla Foundation, which does research in mental health and its social impact. The maiden entrepreneurial foray of the younger scion, Aryaman Birla, was in the hospitality business. He is also involved with several businesses of the group, including fashion and retail, real estate, and paints. And he is working on its foray into new age businesses in consultation with Kumar Mangalam Birla. According to a group company release, Aryaman helped incubate the group's D2C platform TMRW and is a director on its board. He has also been involved in laying the foundation for the group's B2B e-commerce business. Aryaman is also spearheading the group's venture capital fund, Aditya Birla Ventures. The Scions are expanding their roles at a challenging time. The disruption caused by Mukesh Ambani's 2016 foray into telecom with Reliance Jio has battered the Birla Group's prospects in the industry. In 2021, Kumar Mangalam Birla stepped down as chairman of debt-strapped telco Vodafone Idea, formed with a merger between his Idea Cellular and Vodafone India in 2018. By agreeing to convert the interest accrued on Vodafone Idea's dues into equity, the centre recently extended a lifeline to the beleaguered telco. But that is only a stopgap measure. Now, the promoters have to come up with a fundraising plan. Being an acquisitive conglomerate, the Aditya Birla Group has over 50% of revenue flows coming from its overseas operations across 36 countries. Since last year, the group has also been in the process of investing about $9.3 billion in creating new capacities and entering new sectors. Part of this investment is being done by Ultratech to increase its annual capacity to 160 million tons. India's largest cement maker, Ultratech has a capacity of 120 MTPA as of today. This comes after Gautam Adani's Holcim India acquisition, challenging the Birla Group on its own turf, cement. Adani is already India's second largest cement player with a capacity of 70 MTPA, and it also plans to increase this to 160 MTPA. The developments at the group indicate that the seeds of succession are being sown. In the past, India's large family-owned business groups have faced turmoil in the absence of clear succession plans. So, this will send a message of continuity and stability at Aditya Birla Group.
Opinion is clearly divided between two sets of investors. One who believe that, in family businesses, given the fact that these shares are going to get transferred in all probability to some members of the family, it's better they kind of get on board and start getting involved with the business, look at what is happening and start to run the business. There's the other school of thought which actually believes that, there is certain roles and responsibilities of the board. And therefore, there is an age at which people kind of come in and are able to contribute more completely and more comprehensively to what is happening on the board, and therefore, coming in at let's say 25 or 28 or even 35 means that you're not able to contribute completely or in a more full manner to the discussions at the board level.
However, there are essential conditions that have to be met for a succession plan to succeed.
Be it a conglomerate, if it's a Grasim or a Birla Group, they may have multiple businesses. So one needs to show, or rather the business group needs to show that their children have gone through the grind, understand the business, have spent 10, 15 years, got the buy-in from internal and external stakeholders, and then project them for leadership roles and for directorship roles.
When Kumar Mangalam Birla took over as the head of the Aditya Birla Group in 1995, after his father Aditya Vikram Birla passed away, he was just 28. Birla brought in professionals to revive the fortunes of the group, which went on to take over a clutch of companies in India and abroad in telecom, commodities and retail. Ananya and Aryaman will no doubt benefit from his example.
Meanwhile, stocks of Adani Group have been on a roller coaster ride since the Hindenburg report was released. Puneet Wadhwa caught up with market guru Mark Mobius, the founder of Mobius Capital Partners LLP, to know his views on the developments and on the Indian equity markets. Let's listen in.
Hello and welcome to the show. I am Puneet Wadhwa, and today we have with us Dr. Mark Mobius, founder Mobius Capital Partners LLP with us. Hello, Mark, and welcome to the show.
Hi, how are you?
Let me start by asking you regarding the hottest topic being discussed amongst investors in India, the stock rout in Adani Group stocks since January end, and their comeback of sorts in the last few sessions. What is your interpretation of the developments?
Well, of course, the whole situation in India is still very, very positive from my point of view. And you're going to see these slight corrections in the market as a result of various factors. But I think these are not significant. I think this will not really deviate from the general trend of the market, which is going to be up in the next few years.
Okay. You talked to a number of investors, Mark. Have the developments with the Adani Group caused an irreversible damage in the eyes of foreign investors as regards the Indian equity markets are concerned, and especially the regulatory environment here?
Yeah, I know a lot of people have been talking about the Adani situation, but and it represents about 6% of the index, the Indian index. So it's significant, but not that significant to really change the whole tone of the market. We've seen a little bit of a downside as a result of the Adani news, but I think it's going to be short-lived, and you'll see a recovery when people realize there are terrific companies in India, very well managed, with no corporate governance issues. And the fact that this has come out is probably a good thing in a number of ways, because it gives the Indian public, the Indian investor public, news about what's happening with companies, and they'll be more available to look at what's happening in the market. That's one thing. The second thing is overseas investors are probably going to be impressed by the fact that there is such a large company in the market with a huge market capitalization and high leverage, no question about that. So that is going to wake up some overseas investors to the fact that, hey, perhaps there's some other good opportunities in India where the company does not have these problems. So overall, I'm not alarmed by the Adani situation. I think it'll be probably long-term positive.
Some of the stocks Mark, have actually recovered from their recent lows. Do you expect more skeletons to fall out of the Adani Group cupboard, or do you think the damage has probably been contained now and the worst is over?
I think the damage has been contained. I think the Adani Group, of course, is now very aware of the problems they face. Hopefully, they'll be able to reduce some of the leverage that they have. Of course, raising more capital is paramount in order to reduce that leverage. And for the time being, it's probably going to be difficult for them to do it. But I think they will be able to come back to the market once a lot of these issues have been clarified. I mean, after all, there was no secret that the family trust had a big role in the share ownership of the companies. And all these things can come out. I think with more transparency, the issues will be resolved.
Okay. So what's your broad view on India, Mark? Do you plan to increase your allocation to Indian equities, given the fact that valuations have also corrected some bit from the top that they were?
Yeah, I think a lot of people look at the price-earnings ratio in relationship to other countries around the world, and they say, gee, India looks expensive on a PE basis. But we don't look at PE to that extent, because price-earnings ratio is really a backward-looking indicator. What you should be looking at is the forward indicator. Of course, the E part of the PE equation is the key. And what we see for India is growth. So what we focus on is return on capital, return on equity. And of course, you find companies with a high return on capital, high return on equity, usually have low debts. And then, of course, we look at earnings growth, no question about that. And if you look at the macro situation in India, there's good reason to believe that the Indian companies will benefit from this high growth rate in the economy, and therefore will have a higher growth than other companies around the world. So high PE could very well be justified.
In terms of earnings growth, what kind of growth do you project for the corporate India for FY24?
I think for the good companies, you'll see probably 20% growth. For India, with the economy that's growing at 7, 8, 9, even 10%, usually you can expect good companies to have double that rate of earnings growth. So that's the reason why I think many of these companies, good return on capital, good pricing power, they'll have earnings growth of 20% or more.
Okay. The Reserve Bank of India hiked interest rates by 25 basis points on Wednesday, but remains worried that the core inflation may remain sticky. What's your view here? By when do you expect the Reserve Bank of India to pause its interest rate hiking cycle?
I don't think they will pause if the CPI, if the inflation rate goes up. But generally speaking, they've been quite reticent to be too aggressive. And they've been quite wise in the way they've done things. I think they've been much more circumspect when it comes to raising interest rates. But if you look at the interest rate, it's not that high in relationship to what we saw in the past. And so, and of course, if you factor in the growth of the economy, then I think even if they raise the rates, the economy can handle it.
Which other equity markets appear as an attractive investment bet, let's say from a 2-year, 3-year horizon besides India?
Yeah, India's the place to be for the next 5 to 10 years, because we're at a takeoff change in the Indian economy, and the Indian companies are going to do very, very well going forward. And the most important factor, I think, involves technology, because as you know, India has surpassed most countries in terms of software development, software exports, etc. Now they're going to embark on manufacturing of technological products. And you're going to see semiconductors being produced in India. And a lot of people don't believe that will happen, but I sincerely believe this will definitely happen. India needs semiconductors, and they are going to get them. So you'll see the equivalent of TSMC in the near future coming into India.
Thank you, Mark, for joining us today. We hope to see you soon.
Well, thank you very much.
The brief rally in Adani Group stocks came to a halt on Thursday after index provider MSCI said that it will review the free float status of the group's listed companies. Now, what is a free float, or what is known as public float? We decode this for you.
According to the minimum public shareholding or MPS rule, all listed companies in India have to ensure that at least 25% of their shareholding is with the public. And these shares held by the public are called public float or free float. However, shares that are under lock-in or have some lien created over them or that are not easily traded in the market are excluded to arrive at actual free float. Higher the free float, greater is the possibility of fair price discovery. As more shares get traded by a diversified set of shareholders, the chances of arriving at better valuation of the underlying company or asset improves. Shares of companies with low free float are prone to manipulation. Index compilers such as MSCI, FTSE and Nifty consider only the actual free float of a company so that buying and selling the stock is easy for exchange-traded funds tracking the index. For example, Tata Consultancy Services is the country's second most valuable company after Reliance Industries. However, it is not among the top 5 Nifty weights, as the Tata Group firm has a low public float of 27.7%. On the other hand, rival Infosys market cap is half that of TCS, but it enjoys a much higher weightage in the Nifty index as it has more than 80% public float. Most listed companies have adhered to the 25% minimum MPS norms. However, their actual free float is much less. This could be because of low legroom for FPI investments due to sectoral caps. For instance, HDFC Bank is not part of the MSCI Global Index as shares available for foreign investors in the bank are below the threshold set by the global index provider. Another reason for low actual free float could be cornering of shares by friendly institutional investors. In some companies, there are concerns over whether the FPI shareholders are indeed public investors or entities linked to the promoters. A few years ago, market regulator SEBI had initiated a study along with stock exchanges to analyze actual free float top-listed companies. The result of this study is not public. Promoter holding in newly listed companies can be more than 75% at the time of listing. Similarly, promoter holding can overshoot 75% in case promoters launch an open offer or initiate a buyback. Also, companies getting relisted after bankruptcy proceedings can also have high promoter shareholding. In such cases, SEBI grants between 3 and 5 years to achieve a 25% public float. However, this has to be done through specified routes to ensure that public shareholders are onboarded. Some of the avenues allowed to achieve MPS norms are share sale through the offer for sale (OFS) route, follow-on public offering, qualified institutions placement, rights issue, and bonus issue.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
If MSCI lowers the weightings, it may increase the selling pressure on Adani Group stocks. That's all for today. For more news and analysis, please log into our website www.business-standard.com, and we'll see you on Monday morning. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.